Good morning, everyone, and welcome to today's Florida Makes webinar on a very important topic. We had prepared for you a very timely topic on updates to the manufacturing R&D tax credit along the lines of our continuous presentation on how to provide some additional sources of funding, helping with the cash flow of our manufacturers. And this is a very good topic. It's a very popular topic. There's a lot of you that have registered for this. So we're happy to bring this to you. So happy Valentine's Day, by the way, everybody. Thank you for joining us on this day. And I am Ruth Buchanan. I am the Florida Makes Business Development Director. Next slide, please, Teresa. So Florida Makes is here for you. We are here to improve the productivity and technological performance of Florida's manufacturing sector. The organization has been here 10 years. We had our 10-year anniversary. We're very proud of that one. And we had been granted the grant again from NIST MEP for another 10 years. So that is our mission at the moment. And our vision is to be the recognized leader for strengthening and advancing Florida's manufacturing economy. Next slide, please. I like sharing this bullet to our participants just to help you frame what we do here at Florida Makes. This is just a sampling or a big picture overview, but there are 6 capability bullets here. We are here to help with technology acceleration and innovation. We have a whole host of business advisors, experts, partners that help with this, and all the other 5 bullets. Cybersecurity and intellectual property. We had one in November on IP, and coming up on cybersecurity. We have a very strong supply chain optimization group that help with that. Performance assessment and continuous improvement, that's our bread and butter. Our team provide that to our manufacturers. If you're not availing of that, now is the time to let us know how we can help you. We had a wonderful, successful webinar last January 24th on workforce training and development. Got some good feedback on that one. Some of you that attended that actually are now in the program. So that was very, very good. And then lastly, business growth and financial services, in which this webinar falls in. So we're happy to provide that to you. Please keep these 6 capability bullets in mind. And then next slide, please. Let's show Rob's picture, please. At this point, that's me. So at this point, here is what we have lined up for you. We have our wonderful partners from Clifton Larson Allen joining us to be the primary speaker on the topic. And it is my pleasure to give you a colleague and a business advisor very much in tune and experienced in financial incentives. Rob is a business growth strategies and financial incentives. And I will go ahead and let him take over. Go ahead, Rob.
Thank you very much. Good morning, everyone. Appreciate you taking the time on this Friday. So I won't take up a lot of your time because you're not here to listen to me speak. But today's webinar is basically a high-level overview of the R&D tax credits. I know it will be covered, but I always like to reiterate this is that, look, these credits aren't something new. They've been around since 1981. And the manufacturing sector is one of the largest users of this credit. Me personally, I've been focused on these credits since 2010. And for the last 8 years, it's really been focused for manufacturers. So it's a great opportunity to learn more about how you can take advantage of these credits and incentives. And again, we'll go through the process, but that's going to be the next step. So I have the privilege of introducing Maria Morales. She's the principal at CLA. Maria has a vast experience and a lot of knowledge when it comes to this topic and obviously, accounting principles. There's over 20 years of accounting experience that Maria has and brings to the table. Maria has spent a significant amount of time coaching and mentoring young professionals. She's also served on various female initiative committees that focus on the advancement, retention, and empowerment of female professionals. Maria's experience includes servicing as an assistant controller for a privately held aeronautical company. Maria began her career in public accounting with a top 5 international public firm. She has worked with various industries, including, but not limited to, manufacturing, distribution, administrative services, software, healthcare, biotechnology, and employee benefit plans. With that, I'm going to stop talking and I'm going to turn this over to Maria. Maria, the floor is yours.
Thanks, Robert. Appreciate it. Didn't expect quite that of an introduction, but I appreciate the background. And I'm Maria, as Robert said. I'm the growth network leader for manufacturing for the firm. And here at CLA, although we are traditionally an accounting firm, we see ourselves more as a professional service firm that really focuses on predominantly our key strength, deep industry specialization. And we've had about 25 professionals in the state of Florida that have raised their hand and said, I'm really passionate about manufacturing and I want to go deep into the industry and really specialize in that. And, I have the pleasure of having one of my colleagues here, also based in the Tampa, Florida office, that specializes in manufacturing and is actually the lead for our firm of 9,000 employees. Ginny, leads our R&D practice firm-wide. So we're lucky to have her in the state of Florida. She's very heavily involved with Florida Makes and passionate about manufacturing. Last week, her and I were in Tallahassee with our Florida Makes group to advocate for our manufacturers and definitely talk about research and development tax credits and research and experimental cost and some of the legislative challenges that have happened over the last couple of years. Ginny has worked in the profession over 25 years. She's always specialized in research and development tax credits, but also focuses on cost segregation projects as well as other tax services. She started her career with a Big Four firm, and she spent about 11 years in industry. So she really understands a lot of the issues from a client perspective and a manufacturer perspective. And she's worked in a variety of different industries, not only manufacturing, but aerospace, defense, and technology and software. I will be helping Ginny basically monitor the chat. Feel free to ask any questions as we go through the process. If it's relevant to the presentation, we'll pause and ask some clarifying questions. If not, you'll have an opportunity at the end to go through all the Q&A. So with that, I will turn it over to Ginny. Ginny, you're on mute. Famous last words.
Thank you so much for that introduction. I was saying, and I probably should have just kept myself on mute. When I started, it was the Big Six, not the Big Four. I started with a Big Six firm. So I've been doing this quite a while, and I am trying to figure out how to get to the little buttons that move the slides. There they are. I think that's it. Am I moving? Teresa, I might need a little help. I'm sorry. Thank you. So yeah, and Rob and Maria, thank you so much. And Ruth, thank you for having us. Really appreciate that. Wanted to give you all, and I can move to the next slide. Eventually, I might figure out how to actually move these things. We'll start with our disclaimer. We're not providing individual tax advice. We can move on to the next slide. Just today's agenda. So there are two aspects here, and things changed a lot in 2022. So we're going to talk about that. But two aspects here. One is the research and development tax credit. And the, sorry, are the slides getting bigger for you guys? I don't know what's happening there. Sorry about that. So I'm going to talk about the research and development tax credit and what that means. And that the research and development tax credit has been in existence since the 80s. And as Rob mentioned, really good for manufacturing businesses. It's really targeted at you guys, right? We want to incentivize innovation in the United States. So we're going to talk about some definitions and how do we figure out how much we might be qualified for. And then we're going to talk about the capitalization. This is what started in 2022. And this has been really negative for our manufacturers. I'm going to talk about, how do you figure out what do you have to capitalize, and then where do we see this going in the future? We can move on to the next slide and forget about this weird growing slide. Sorry, I'm trying to, oh, okay, it's doing it again. I have no idea what the presentation is growing, but that's okay. We're just going to keep going. So if you are a manufacturer and you are in, you have these kinds of activities, you've got an engineering department, you've got people that are in new product development, you've got people you have an account called research and development, you're doing process improvement, or you're developing prototypes, you probably have research and development costs. So I'm going to pull up my slide so we can keep moving.
Jenny, we are trying to take off the animation, but just keep going. People are here for the
no worries.
content. Yeah.
Oh,
yeah.
thank you. I'm sorry about that, y'all. So we can move on. I think we covered all of this. We can move on to the next slide. And I don't know if I probably did that trying to figure out how to move the slide. So don't blame Florida Makes, guys. Blame me. I don't know how we did that. Okay. So back on track here. This is the definition of qualified research expenses. So in order to qualify for the R&D credit, you've got to meet this 4-part test, right? So this is the definition of qualified research activities. And so any activity that you're going to try to claim has to meet this 4-part test. The activity itself has to be all of these things all at the same time. The first element is permitted purpose. So we are talking about, you are creating a business component, that's a permitted purpose, that you want to sell to other people, or you're going to somehow use to make money. So a business component can be a product, a process, a technique, a formula, a software, but it is something that you're making to sell to others. So that's the first element we're working on. So it's related to that. The second element is technological in nature. The activities that you're doing have to be relying on principles of hard science, biology, chemistry, physics, engineering. That's what we're looking for here. And as well, computer science and software engineering. So if you're developing some kind of firmware, for example, for something that you're making, that kind of activity would be technological in nature. Third element, elimination of technical uncertainty. You don't have to actually eliminate technical uncertainty. What we need here is you are undertaking activities that are designed to eliminate technical uncertainty, right? So we're working toward the elimination of technical uncertainty. It means that in order to substantiate that you have R&D, you have to be able to articulate what are those technical uncertainties. Is it a capability uncertainty? We might have a medical device company trying to develop some kind of device to do something, and we're not even sure that we can. Methodology uncertainty, like we know we can do it, right? In the case of maybe software development, we know we can write a software that does this thing, but we don't know exactly how to get there. So those are the kinds of uncertainties we'd be looking for. And then lastly, the last part of the 4-part test is process of experimentation. Goes right in hand with the elimination of technical uncertainty, right? We need to show that there is an iterative process, that we are testing hypotheses. We're doing this iterative process of design. So we can move to the next one. I see the little button. Oh, okay. So 3 additional elements that we always have to consider when we're thinking about R&D tax credit. So the party that gets to claim R&D credit is the party that bears economic risk of loss for those costs. So we're really thinking here in terms like fixed price contracts under a fixed price. Now, let me back up. If you are developing products, your own SKUs for you to sell to your customers, clearly you have that, right? You have economic risk. It's your money you're putting on the line. So if you're going to pay for those costs, that's your economic risk. Where it gets a little sticky here is when you have a customer that's paying you to do some kind of development or paying you to create something. Then we have to look at the contract, and under a fixed price contract, you would be the party. So if you're the seller, you've given a fixed price contract to your customer, then you have the risk of loss, right? Because you're only going to get, let's say it's $10,000. I'm getting $10,000 and I have to deliver a deliverable that does X, Y, and Z, and I'm going to have to do development to get there. That is not considered funded research, meaning the other party's funding it, right? You are funding the research because you are at risk. If it costs you $12,000 to do it, you're still only getting $10,000. So you have that economic risk. The party that claims the credit must also retain rights in the intellectual property that's developed. So you have to have risk and rights. Rights can be shared. So you don't have to have exclusive rights. You just have to have rights in that IP. And then finally, in order to claim the credit, the activities themselves must take place in the United States. So we're really looking at where is the person doing the activity actually sitting. We can move on to the next one. So these are some items that are specifically excluded from R&D tax credit. Research after commercial production, that's pretty standard, right? Once you've gotten to the point where you're ready to roll this down the production line, we're done with R&D. However, if you think about it, you may want to add a new feature or a new functionality. And in that case, we're going to then roll back into R&D on that feature or functionality. Things in this, I mentioned earlier, we're looking for hard science, things in social sciences, arts, humanities, that's not hard science. So those are excluded and they are statutorily excluded. Research in cosmetics, taste, design, those kinds of things, you know, that it's more an aesthetic, that's excluded. Adapting an existing business component to a particular customer's requirement. So just, you know, changing settings on something, that's not going to be qualified. Again, and then there's not a lot of time in these. Duplicating an existing component would not be qualified, but again, if you're doing something different, you know, in the next round, that could potentially be qualified. We can move the next slide. All right. So what do I get to claim? What costs when I'm talking about I talked about the activities, and now we're going to switch gears and talk about what are those underlying expenses that we get to drop into our qualified bucket. And I will explain that the credit is a percentage of these costs that you're putting in. And there's a calculation for doing it, and I'll talk about that briefly. So the costs that you get to claim are the wages for the time that your employees are actually working on doing this activity. And it also can be, so that's the direct. You also can claim their direct supervision and the direct support. So supervision might be the engineering manager, spending time with the engineers as they're directly doing these activities, having meetings with them to talk through their issues. Direct support might look like your best machinist, who's the person you always have, you know, try to build the new part or design, you know, run the plans through the machine and develop that. So you can take, so the way this works for wages is you take the percentage of time that an employee works on qualified activities times their box 1 W-2 wages, and that's what's going to drop into the qualified bucket of costs. So it's great if you have actual timekeeping, but if you don't, you can use something like a time survey. You know, we have lots of different ways that we help our clients get to that answer. And then the next element that we can claim, the next bucket of costs, is supplies. Supplies is generally going to be expected to be a relatively small number compared to the labor costs, but supplies would be anything that you generally consume in that R&D process. So this isn't going to be anything that is a depreciable asset in your hands. So if you buy, you know, a new CNC machine, that's not going to be R&D, but the materials that you consume, you know, that we had that machinist running those test parts for us, that the materials that you use there, you could claim. And then contract research. So if you're paying 1099 contractors, if you're paying for outside services in some way, you're paying for maybe testing labs, those are the kinds of costs that you could consider contract research. You get to take contract research at 65%. That's just statutory. So that's going to, 65% of that is going to drop into my qualified bucket. And finally, if you're doing any kind of software development, least computing costs would be includable as well. Least computing cost, the reason they call it, the reason it's defined that way rather than cloud computing is that this was in the 80s, right? And so what they're talking about here is you're paying for time on a computer, You don't own the computer's not on your premises, and you're not the primary user of that computer. So something like Amazon Web Services would be includable for the development environment that you're using. All right, next
Jenny,
slide. Yes,
Jenny,
ma'am.
one clarifying question and
Yep.
almost a statement, I should say.
Yeah.
On the contract, a lot of times people will contract with a third party to help them with some of the research. Can you make a distinction on domestic versus international? Because a lot of times we see clients that use
Yes.
international individuals to do some research and development for them.
It's a really good point. So if you use overseas contractors, that's absolutely fine. You can do that, but you cannot claim R&D credit for anyone that does not, anywhere the activity didn't take place in the United States. So if the contractor is overseas, you just have to exclude that from the R&D calculation. That does become a problem. It's a more negative outcome when we get to the capitalization, Maria. We'll talk about, like, that's going to be a negative there, because the amortization period for domestic costs is 5 years, but for foreign costs it's 15. Does that cover it? Okay, cool. I think we can move to the next slide. So how much is the credit? You're going to get on average between 5% and 10% of the qualified expense. The credit can be claimed. You can go back. There's a statute of limitations on your tax return. That's good news, right? For after 3 years, 3 years from when you filed the return, or 3 years from the due date of the return, kind of depending on whether you extend it or not, the statute of limitations expires and they can't come after you, but you also can't go back and get refunds from prior years. So anyway, next slide, please. So I know this slide is a little bit torturous, especially for any non-accountants on here. What I wanted to do with this slide is just help you understand, like, how does the calculation work? There are two methods for calculating the credit. One is the regular. We're not going to talk about that. That requires you to have base information from year 6 through 10 of your existence. So if you've been in existence since the 80s or since even the early 2000s, and you haven't been doing credit, it's probably too hard to get there, but every client can use, every taxpayer can use the alternative simplified credit. And if you look kind of right in the middle on the right-hand side of this box where I've got year 2020, 21, 22, I'm showing you that the average spending has been $1 million for the past 3 years. That's important because that goes into the calculation. So you take your average spending for the prior 3 years, in this case it's $1 million, and I'm saying in this current year we spent $1.3 million. So the math works like this: $1.3 million minus 50% of the average of the last 3 years. That net number, you see that current QREs less hurdle of 800,000, that's what I get to take the credit on. So I'm going to get 14% of that number, which in this case is $112,000. So I just want you to understand, you're going to get more credit as your spending goes up and less credit as it goes down, because that base is always shifting. Hope that makes sense. And if you think about it, if we change that $1.3 million number to $1 million and just say we're always spending $1 million, we're always spending a flat spend, $1 million minus the $500,000, 50% of the average of the last 3 years, would give me a net of $500,000, and I'd get 14% of that, which is $70,000. $70,000 is 7%. That's where I'm getting my average. Somewhere between 5 and 10% is generally what you're going to get. You cannot get more than 14%, and you can go as low as 0. So next slide, please. So that really was the coverage on the R&D credit. I tried to keep it high level. I'm sorry about the math, but I bet I've got a lot of engineering minds on here that can absolutely follow it. So moving into the capitalization of specified research expense. Thank you for that, Teresa. So this started, I'm going to give you a little bit of the background here. This started when Congress was trying to pass the Tax Cuts and Jobs Act, also sometimes referred to as the Trump tax cuts, in 2017. They passed this law, and they did it through this process called budget reconciliation. A lot of you probably know this process, right? They're actually just starting it now for trying to extend those TCJA cuts. So they did this process through budget reconciliation. And what they did was they said, we want to cut taxes and we need to show that over a 10-year period, we want the budget scoring to look like we're not actually, spending, we're not actually raising less revenue. So what we'll do is we'll just say, well, starting in 2022, which is a lifetime away in politics, 4 years later, we'll have we'll just say that companies can no longer deduct their research and experimentation costs, and then we'll just raise a whole bunch of money out of that. It's been terrible for you guys, manufacturers. It's just been awful. I've had the most painful conversations over the last 2 years. As a matter of fact, I took on my role as R&D leader 2 weeks before we entered the busy season for filing the 2022. And I will say to y'all, if somebody didn't tell you about this before 2022 ended and you were surprised by this, that's not surprising at all. We were all surprised because everybody thought Congress would address this. It in no way, like we talked about with the R&D credit, we want to incentivize companies to do R&D, to innovate in the United States, and that's why we have a credit. And that is also why Congress passed in 1954 the the original Section 174, which broadly permitted deduction of R&D expenses. So this switch means, and I'm going to talk about that a little bit more in another slide, but this means that you have to capitalize and amortize your costs. So a domestic cost over 5 years, as I mentioned before, and for anything foreign, anything being funded by a US company on foreign soil, you're going to have to amortize over 15 years. We can move on to the next slide. So common 174 expenses. So as I mentioned before, we defined research and development tax credit expenses. So anything that is eligible for the research and development tax credit must first be a Section 174 expense. So I know anything that was in that bucket, anything that was lighting up in your mind saying, oh, I could take credit for that cost, those are definitely capitalizable. There are other costs that would also be capitalizable. You may remember I mentioned that when you take salaries for the R&D credit, you take box 1 wages. Here under 174, you have to take gross wages. So that's going to include your fringes and payroll costs and any other kind of employee benefits. Under 174, you would also not take 65% of contract labor, you take 100% of contract labor. And then there are other costs, overheads and legal costs, and just a whole plethora of costs that have to be allocated in. So I think we can move on to the next slide. So there has to be, when you're figuring out how to do that allocation, you're going to have to do a cause and effect relationship. Like, for example, rent would be a cost that you would need to rent, or your depreciation on your facility. You would need to include some portion of that in that 174 cost. I feel like I may have skipped ahead a little bit here. And so if anybody has a point of clarification question, please feel free to ask it. But you're going to have to take the costs, that kind of that core bucket of costs that I said, it's a process of experimentation. You're working to eliminate uncertainty. It's those direct wages. And now I'm going to have to allocate, like, what else is the R&D department benefiting from? So it would be, things like rent, things like, I mentioned that already, things like your travel costs. This made me absolutely crazy when we first went into this. I was like, are you telling me that I'm depreciating something over 5 years and then I'm going to take a chunk of that depreciation and I'm going to stick it in something I'm now going to amortize over 5 years? I think that's insane, but that's tax law. That's all I can say. So anyway, you do have to figure this out. Now, you could have different types of costs allocating in a different way, right? So maybe the way you're going to allocate your benefits costs is going to be, or your travel costs or whatever that is going to be like a head count, or you're going to take the labor costs, right? Your R&D labor divided by total labor and get a ratio and allocate that way. And then you also could do it by square footage for certain costs. Rent would be a good one where you could do it that way. We can move on. All right. So kind of back to, originally this law was passed in 1954. We wanted taxpayers to really understand that they had broad rights to deduct these 174 costs. So if you think about it, if you develop, let's say you develop a patent and then you sell things, you might have thought back in 1954, the IRS would make the argument, well, you're going to benefit from that development of that IP over time, so you should have to take the cost over time. But the government was like, no, we want companies to innovate. We want them to be able to just deduct, right? And make their taxes lower. So flipping this 174 and turning the switch and saying, well, now we have to capitalize those costs. Well, because the law was so broadly written, it's really, really onerous, right? Because I may not have developed anything. I'm just working on development. I don't have an asset. I don't have really, there's nothing that I can point to that I actually have, yet still we're being told, well, you have to capitalize this cost. So, and back to my point about IRS, so IRS not only did none of the accounting firms or none of the people in my world think that we would be dealing with this actually taking place, but the IRS didn't either. So the law was passed in 2017. It started at the beginning of 2022. And then we didn't get any guidance until probably February of 2023, right? And that was just procedural guidance. That was just, how do you make the change on the forms? But it didn't tell us anything about what costs do they think need to be included. That finally came in September of 2023. So if you think about that, 2022 returns, we closed the year 12/31/22, and then we had to file returns or extensions at least in March and April, right? And 6-month extensions for C Corps and partnerships would take you to September 15th and October 15th for individuals and C Corps. So we finally got guidance on September 8th, 1 week before our partnerships and S Corps were due, right? I mean, it was insane. We were like, okay, we finally got some guidance. Well, by that time, we'd made lots of decisions and filed lots of returns. Almost everything was already baked. And let's be honest, we couldn't do much with a week's time lag, in order to file those returns. So the 2 notices at the bottom came out and clarified a couple of points in 2023-63, but there are things in that notice. It signals where the IRS is kind of heading and thinking, but there are things that contradict themselves. So I mentioned earlier that if you are trying to take the R&D credit, you have to have risk and rights for those costs. Well, the IRS looked at that and said, well, let me back up. If one party has risk and another party has rights, then nobody gets to take the R&D credit, okay? IRS is looking at that and saying, well, if one party has risk and one party has rights, somebody still has to capitalize these costs. And we have to figure out how to give you that guidance. The guidance they gave us makes it appear as though both parties in that scenario would have to capitalize the cost, and that does not make sense, right? So the subsequent guidance came out and essentially said you can follow 2023-63 in whole or in part. So we've just been making a lot of arguments with our clients, like, what are we going to do? Where there's gray area, we're going to probably try to err on the side of the client at this point, but understanding that risk, that there's potential risk in there on those choices, but it's really been a struggle. So the next slide, we can talk about where are we on the IRS regulations. They have issued no regulations to date. We're expecting proposed regulations early in 2024. The last thing they said was we would get them early in 2025, first quarter of 2025. This is from the IRS Chief Counsel's office. They said you'll be getting them in a matter of months and not a lot of months. That was almost a direct quote. Now, though, with the new presidential administration, they have put a moratorium on the issuance of any new government regulations, and we believe that it will apply to this. So we now don't even expect that. So, I mean, the good news for that, without regulations, as I mentioned, you really kind of get to make some discretionary choices in here, right? I mean, the core things I described, that those things must be capitalized. And I don't know if I was super clear about this, but the capitalization is not a choice, right? This is the law. You have to do it. The R&D credit, that is optional. Like they don't care if you take a credit or you don't take a credit, but this capitalization piece you do have to do. So we do think that they'll use that 2023. So if you Google IRS Notice 2023-63, if you need a little light reading, it'll really explain like where we think they're going. But they do need to fix things like the double capitalization, and they need to tell us what's going to happen if we, if we close our business or dispose of this entity. So lots of points of confusion. So the last thing I wanted to cover, which I suspect a lot of you may be really interested in, and is on the next slide, is what are we reading in the tea leaves? What do we think is going to happen? And so we obviously know, I mean, Congress is working on a couple of bill options. The House wants one big beautiful bill, as the president said, and the Senate is talking about doing 2 reconciliation bills. 2 reconciliation bills is aggressive. I don't know how to say that. So getting 1 reconciliation bill through is a massive achievement, and getting 2 done in 1 year just seems, I shouldn't probably say crazy, but it's a really hard to imagine that can be done. Now I will say, late last night, the Republicans approved a resolution to move their 1 bill process forward. So that is good news. So they're working on the extension of those tax TCJA provisions, right? The tax cuts we got starting in 2018. They're moving forward on that. But also they're rolling in border security, immigration. There's a lot of other issues being included in that. I do not see in any way that getting passed before the end of April. Like it's just not going to happen. So there is bipartisan support for the reinstatement of full expensing of 174 costs. There's been bipartisan support for that the entire time, y'all. That's the frustrating thing. So the issue we're going to have, my 3rd bullet there, it's viewed as a pay for, right? We're going to have to figure out, if we're going to let companies go back to full expensing, how are we going to pay for that? Where's the money going to come from? And so this is going to be the hurdle that we have. And something that makes me nervous, as somebody who desperately wants this 174 legislation to go through, is just that I'm not hearing it, right? I'm not seeing it. I mean, I read, I'm looking constantly for more updates and trying to figure out, like, are we going to get this through? I pay attention to NAM. NAM has good information on their website. They certainly support the repeal. What I will say is, I do think maybe the best bet we have is that they come up with some sort of small business carve out and let businesses like yours continue to deduct, and have the Apples and the Teslas of the world, they can afford to capitalize, and they have strategies for dealing with it. I would say that retroactive repeal at this point, I don't see that happening. I think that's off the table. And I do think that no matter what happens, nobody in any case has talked about the repeal of the foreign component of this. So if you're offshoring something, to Maria's point, if you're offshoring something and you can onshore it, it will be a better taxable outcome for you. So that is the end, Maria, of my formal, and I know you have some questions for me.
Yeah, no, I appreciate that, Ginny. So maybe just one clarification, and maybe you could just summarize really quickly in layman's terms. I think a lot of times our clients get confused. They just hear R&D and they go right to credit. They don't really understand the difference between credit and a deduction sometimes. And so a lot of time business owners rely upon their CFO to like figure that out for them. And they don't really understand, like, well, one's a deduction, right? So, and that's very different than a credit, and that they're not synonymous. Maybe you can just kind of cover that really quick.
100%, absolutely. So a credit is generally considered better than a deduction. So let's just say you have $1 million in revenue and you have $900,000 in costs, right? You have $900,000 in deductions. So your net taxable income is $100,000. So those deductions got you to the 100,000. Now I'm going to pay, let's say you're a C Corp, just because the math is easier for me. So you pay 21% corporate federal tax on that. So your tax would be $21,000. If you have an R&D credit of let's say $11,000, you paid $21,000 in tax, I'm going to take $11,000 to offset that tax. So then your tax liability, instead of being 21,000, would be 10,000. So credits are generally better than deductions because they're a dollar for dollar reduction of the actual tax, not a deduction, which is really you're giving yourself like a 20% benefit. Does that make sense?
Perfect. No, that's helpful. One of the questions that we did get was regarding, I think, the R&D credit itself and whether or not you have to sell what you're developing. So I think the confusion was around tooling, right? So if you're developing a tool and there's R&D
Yep.
associated with those costs, do I qualify that or do I have to sell that tool? Or what's
Nope.
the distinction there?
Nope. Such an excellent question. I'm glad it was asked. And so the cost that you're incurring can be a product or process, technique, formula. So when you are doing something to improve your production line, like new tooling, that is very likely qualified, right? So what you need to be doing has to be related to what you sell. And I know, you know how we are, Maria, we get so technical. And so like, if this, then that, but essentially it's got to relate to what you sell as a business. And so if you're developing something for your internal use, for example, if you decided to develop your own ERP system, and it doesn't touch customers at all, that would be you might be able to take credit for it, but it's a higher threshold. So when I'm trying to be clear about that. And for this discussion, that doesn't even matter. So tooling would qualify.
Perfect. There was another question regarding, a lot of companies worried about the Senate and whether or not they're going to go back to the credits that were at the levels of 2022. Maybe if you can comment on that.
Yeah, so the credit hasn't really changed. It's the capitalization that's
just
changed.
Capitalization piece.
Yeah. So I think that question is probably getting at, do we think that we're going to go back to full expensing? And, the answer is, I'm a little bit skeptical, I'll be honest. Like, I desperately want them to restore that. And if the person who asked that question, if I'm not answering it correctly, please feel free to ask again.
Yep. Yep.
Maria, can I just, Jenny, on that question, I think it's more of, since it's still potentially be voted on, should they, file for an extension to see if it's going to be?
I would. I definitely would. I would for a couple reasons, Rob. One reason is that even if you want to file on time, let's say you're a C Corp and you want to file by March 5th or April 15th. Even if you extend the return and you file on April 16th and you go ahead and pay whatever's owed based on this, you are able to file a superseded return, right? Because you extended. If you didn't extend, you can't do a superseded return. You'd have to do an amended return. So we recommend to clients that you extend, and if you can wait, just wait and see what happens with the tax situation. And we're not lobbying, or we do advocate, right? We were just in Tallahassee. I would say call your congressman, make noise about this. They need to hear from small business, how damaging this capitalization is. And you will hear them say to you that it's, if you think about it, by the end of 2024, you're going to have deducted 50% of what you had to capitalize in 22. But I don't think that Congress understands that even though I'm going to be almost whole in like deducting the full amount by the time I get to 2027, I still have all this capitalized cost like sitting out here, right? They've grabbed all this cash from y'all. It's still gone. So getting to year 6 where there's like, I hope I'm making sense, but it's still bad. We need to get rid of it.
Got a lot of good questions coming through. This one I really like. It's regarding industry. So someone asked if banks qualify. Maybe you can talk about CLA's credit.
Banks?
Yeah.
Yeah, no, actually that's a great point, Maria. So as an accounting firm, we take an R&D credit, and I, as the leader of the group, I get the privilege of calculating that credit. So we are doing all kinds of things, innovating in our firm. So we have I don't think this is secret and proprietary, Maria, that we have this scheduling tool that our folks have been developing. And we've spent a ton of resources on developing tools for us to use, and that is the way we deliver value to our clients, right? So the scheduling software that's been developed, we claim R&D credit for that, among a lot of other things that we're doing in the background. So it would not surprise me one bit to see R&D in a bank where they might be developing, all kinds of different apps and tools and software, anything that interfaces with your clients or relates to, what you sell, what your services that you provide could potentially be qualified.
Another good question. Can a credit be a positive return, meaning actual money return?
It is not a refundable credit. So you have to be a tax-paying entity. Yeah, Maria and I talked about this a little earlier today. You have to be paying tax in order to benefit from it. There is one exception, and I know, Florida Makes may work with some early stage companies. If you are pre-revenue or recently started having revenue, and what I mean by that is in the last 5 years, you can actually calculate your R&D credit, and then you can take it against future payroll taxes. But you have to have had no revenue prior to 5 years ago. So for 2024, that's going to be prior to 2020. If you had zero, if you never had revenue prior to 2020, so there is a way. They tried to, they actually passed this in 2016, so that companies in that situation, if you're in a loss, you have no use for a credit. And thank you for that, under 5 million in revenue. It is also true that you have to be in the current year under $5 million in revenue.
A follow-up, that's a common question that's asked of us. Should you do the R&D tax credit if you do not have a tax liability?
It's a tough question. If you're a flow-through entity, I recommend at least looking at it, at least exploring it. And the reason I say that is the credits expire, right? The credits carry forward for up to 20 years. So you can calculate the credits and carry them forward. So if you think you're going to turn the corner, I would maybe consider doing it, because you are fighting that 3-year statute of limitations, right? So
yeah.
If I did a whole bunch of great stuff in 2020 and I filed that return in 2021, well, that's going to expire. And in 2026, I'm not going to be able to use it. So it definitely can be attractive, for investors to see the credits that have been built up. So if you're thinking about selling your company, the one thing I will say, Maria, for C Corps, I feel like this is little known. For C Corps, if you're in net operating loss, and the net operating loss from a particular year essentially holds the statute of limitations open. So yep. You can go back, but this works for C Corps. It doesn't really work for flow throughs.
More great questions. So there's a company.
Maria, if I may just interject very quickly, just a technical note to the attendees posing questions. We would prefer that you please post it in the group chat so everybody has the context. I just realized that some of the questions, Jenny and Maria, that you've been addressing was only being seen by us.
Gotcha.
So, yeah, so if you can please post them in the group chat. Thank you.
So just following on, I'm up to the next question regarding a company that manufactures pumps for construction industry. So buying CNC machines that are used to make components for the machines they build. And they've started a new product line, not newly developed machines. Can we deduct these part of the expenses as we incur them on the CNC machines?
The CNC machines themselves.
Mm-hmm.
The CNC machines might qualify for bonus depreciation, but that's a little out of my wheelhouse. But for R&D credit or R&D, they would not, because they're a depreciable, a CNC machine itself is a depreciable asset. Yep. So it would not be part of R&D. Now, the materials you use, in setting up your process and, in doing trial runs, the materials you use in there, the metal you potentially use, that could qualify. But it'll be really small compared to the cost of a CNC machine.
And then there's a question in regards to what classifies as small business, the same criteria that they use for the SBA based on zip codes. Okay.
Yep. So if you want to be considered a small business, you have to have had less than 5 million, and this is for the payroll credit. So the IRS probably has 9 different definitions of small business, but for this particular piece of small business, less than $5 million of revenue in the current tax year, and you could not have had any revenue prior to 5 years ago. That's the definition of qualified small business for the payroll credit election.
Perfect. There's something regarding a proposed tax credit for CMMC. I'm not sure if you've heard of that before, or if that's.
I know CMMC because of my time working in defense contracting, but it's not something I know about. So I'll just be honest.
We do have Sarah. Yeah, we do have a webinar on CMMC in a couple of weeks with Cyber Florida.
Oh, nice.
Yes, I will make sure that we ask that from our Cyber Florida folks, or if I get some answers quicker than that, Sarah, I'll let you know. Thank you for that question.
So then I think the last comment or question that I see out there was regarding an R&D tax credit that they filed for years, and last year they got denied for a portion of that. And so they were told specifically that in regards to PO, that a formal contract needs to be generated to qualify. Are you
Formal contract
following that along? And maybe Chris, we might need some more clarification.
Yeah, we might need some more clarification on that. Well, and I guess I would be curious, denied by who? I mean, unless there was an audit. I will say we don't see a lot of audit activity among our client base with R&D credits. We have over 1,000 clients, just over 1,000. So let's just go with about 1,000. And we probably have 3 clients that are under audit for R&D. So it used to be a tier 1 issue where it would really draw scrutiny, but now it really doesn't. But the one thing, you know, the thing I will hammer, and I probably did not hammer enough in the R&D credit part of this, documentation. You've got to document, like, how do you meet that 4-part test? You know, explain what your projects are. You need to show a nexus between the time employees are spending, the supplies that you're consuming, and how is that qualified? Like, you know, and that's getting harder and harder with the court cases that are coming out. They're scrutinizing it. So
I don't know if you saw the Q&A chat, but someone put in like exclamation points, documentation is very important.
Okay. I did not see it.
So right on cue for that one.
Thank you for that comment, whoever put it.
Maria,
ahead.
interjecting again, because there's a lot of things coming in the chat and in the Q&A. Did we address this one? Our company manufactures pumps for construction industry. Did we address that one yet?
Yes.
Okay. And the question on classifying small business, did we address that?
Yeah.
Okay. Sorry, guys, there's a lot going on. I just want to make sure.
Yeah, it's going into two different chats. So I started on the one chat and then moved to the other chat in order. And there are a couple more chats. Let me just go back to the last chat just to make sure we didn't miss anything here.
I saw a question about software, and I will say there really isn't one. You know, I just saw that one pop up, Maria. There isn't really a good software out on the market. I go to a big conference in the fall every year to talk about R&D, and we talk about it. We'd love to get some automation. If there's somebody who wants to innovate that, please develop the software for us.
So I think exactly. There's one last question. How does a build out for our building fall into R&D? So I know you can comment on
A build out for a building?
Yeah.
Generally, I would say it doesn't. You know, generally you wouldn't have R&D, although when you're setting up, if you know, we're talking about a manufacturer, and you're looking at setting up your production line, you know, there's a whole bunch of process improvement in that. So there's potentially some qualifying activities in, you know, you're going to have to set up your production line. You're going to have to do some test runs. You're going to have to, you know, experiment a little bit there. Because again, you always have to go back to the lens of the 4-part test. Is it related to the products I'm developing? Is it technological in nature? Am I working to eliminate uncertainty? And is there a process of experimentation? So if you ask me any question any client ever asks me about does this qualify? I'm just going to run it through that lens.
Perfect. And I think that's it. I know, Robert and Ruth, you had mentioned that there might have been an advanced question regarding hurricane extension. So we can get you clarifications on that and maybe something that summarizes nicely what those deadlines are.
Perfect.
Great.
Yeah, thank you, Jenny and Maria. That was a lot of questions. Thank you, everybody, for sending in your questions, concerns, and comments on this topic. And I just want to, Teresa or Patricia, could you show the 3 key takeaways, please? And then I'm gonna go back to Rob. So today we had these 3 at the beginning, and I hope that we were able to meet them, is to recognize what activities and expenses qualify under these tax credits. And Jenny, I think described well how you can apply those credits against the income. And then the Section 174 capitalization requirement was a very good discussion as well. At this point, Rob, do you want to go ahead and make a statement on working
Sure.
with your advisors?
Absolutely. Again, Jenny, Maria, thank you again for your time. Thank you for updating us where the R&D tax credit stands. I know some people have maybe taken it in the past who have joined the call and wanted to get an update, and there's probably a few people that have never taken it in the past. So one of the keys, as Ruth said early on, is that Florida Makes has been around for over 10 years, and we've been strengthening and advancing Florida's economy by improving competitive productivity, technological performance of Florida's manufacturers. One of the things we do, such as this R&D credit, is let you know what's out there that can help you, again, put money back into your pockets for something that you've already done. I know Jenny and Maria didn't bring it up. Like I said, there was a lot to cover in a short period of time, but this credit has, there's some gray area, but it's black and white. Either you qualify for it or you don't. The key is how much of your wages and expenses can go into the, the QREs. So this was a high level. The goal is that if you want more information, we should set up a one-on-one with the Florida Make business advisors. So in a second, I'm going to put my information in the chat. No matter where you are in Florida, reach out to me and I will connect you to the business advisor that's in your area. And we can have that one-on-one conversation to see if it makes sense to look at taking these credits. Like Jenny and Maria said, it can't hurt to take a look to see where you qualify or where you sit with these credits, because it's a great opportunity. And like Jenny said, I believe that they're going to go back to it. We just don't know when, especially with the new administration and the focus on innovation and growing things in the US. This is what that credit was built for, to help you there. So with that, again, I'm going to put my information in the chat. Please reach out to me and we can set up a one-on-one for the R&D and many other things. With that, Ruth, I'll turn it back to you.
Thank you. Thank you so much, Rob. So just for housekeeping, there will be a link sent to all the registrants from the Zoom event. So you should have that automatically from Zoom momentarily. There is a second email or like a pop-up after you attend of a survey. We would love to get your input. Your input, questions, comments help us ensure that the webinar series remains responsive to our Florida manufacturers' needs. So please do that. And there will be a separate email from me with the slides from today's webinar. So you will get that. I have 1 more minute. So to my fellow economic developers, I've seen that many of you have been attending this regularly. We hope that you are beginning to understand the role that Florida makes in the state ecosystem. Please make sure your manufacturing clients are aware of who we are and our capabilities. And as Rob just illustrated, we have Rob and his teammates that will help amplify your BRE efforts. So please keep that in mind as we go through the year. Lastly, very exciting webinar announcements. In 2 weeks, we're going to talk about tariffs. Yes, we expect this to be very, very popular. So in 2 weeks, we haven't published the link, but very soon we will publish the registration. March 14th, as mentioned earlier, is Cybersecurity and CMMC with our education partners, Cyber Florida. Followed in 2 weeks by Tariffs Part 2. We know it's going to be an important topic, so there's 2 webinars on tariffs. And then also April 11th, the second part on cyber. So tariffs, cyber for the next month or so, 2 months. Thank you all for attending the webinar. We will see you in a couple of weeks. Happy Valentine's Day. Bye-bye. And thanks to CLA, by the way. Thank you, Jenny and Reed.
Thank you.
Goodbye, everyone.